Hi, this is Mike Maloney, and I've got Jeff Clark with me in another What the Fact. It's hard to say that with a straight face, but it's FAQ, so the frequently asked questions. So, Jeff, what do you got for me?
Well, it's great to be back with you again, Mike, for a frequently asked question. You have revealed recently that you started to buy some mining stocks. Now, this is an area that I love to invest in. Of course, I have my gold and silver in place first before I started buying mining stocks, but it's something I really enjoy. So, this naturally raised a question with some viewers as to how much you're investing in mining stocks versus your gold and silver holdings. So, Mike, do you have any guidance there on what allocation you personally plan to eventually reach in terms of how much you have invested in mining stocks versus how much you have invested in physical gold and silver?
I'm. I don't think I have hit 5% of my portfolio yet. Um, it's possible when you've got a certain quantity of precious metals. Um, the level of anxiety about the global economy, and I have a lot of anxiety about the global economy, even though I've got the precious metals, but the level is reduced greatly if you do own the precious metals when you hit a threshold where you go, okay, I've got enough right now. I can retire, live the rest of my life without having to worry about anything because I know that they can't go to zero. And I know that they're not going to drop. It's possible that we could see a 90% drop in the stock market. It's not possible, in my opinion, that we could see a 90% drop in precious metals. And this is if you're using the dollar to measure them. But you really need to use their value. And this market hasn't peaked at all when you look at the Dow gold ratio and the gold real estate ratio and all of this. We have a long way to go in this market, some big gains to make. But once you get over a certain threshold to where you know that you're sort of taken care of, the anxiety is reduced. But like I say, I read a lot of news, and I do get a lot of news that has been filtered. And so, because it's Cameron's news that's posted on the website, it's things that Dan sends me or other people in the company. And so it tends to be economic news, and it tends to be economic bad news. But these things are real. And it doesn't matter if you're listening to the fairy tale that the mass media is telling the public, or looking at these things that you can dig deeper and can go to the Fed's website or the ECB or the BOJ, the European Central Bank, Bank of Japan, People's Bank, and you can read these things. And or it's some commentator commenting about these things. But if you investigate it, this stuff is real. It's dangerous. It's happening right now. And you got to be prepared. So that raises the level of anxiety. But I've got, I first was just investing in precious metals. Then I was, well, I can't say my full history. When I first got into the precious metals sector, I did accumulate a lot of mining stocks. I had 53 different mining stocks. Back in 2003, I started collecting those. And I caught the last big leg up where if you take the HUI or the XAU, the indexes of precious metals, these used to be the major indexes back then. They didn't have the GDX and the GDXJ. So the HUI was the unhedged gold and silver mining companies. And you divide that by the price of gold. I caught the last leg up where the miners really vastly outperformed the precious metals. And then I was lucky enough to do some research on it and get the Barron's Gold Mining Index, which goes way, back many, many decades before we went on to before we went off of the Bretton Woods system. So it goes back, and then you can paste that onto home stake mining and the things that did really well during the Great Depression. But when I divided the Barron's Gold Mining Index by the price of gold, I found that over the long run, just the physical metals outperform the stocks. It's only in these short periods of time, either direction, where the stocks are outperforming gold, but then on the way down, they outperform gold. But it seems like they give you a leverage of 3-to-1 on the way up and 4-to-1 on the way down. And so if you go from 1971 until today on this index, the Barron's Gold Mining Index divided by the price of gold, gold has had 8 times the performance of the stocks if you're taking that whole period of time. However, I did have one stock where I had a 40 bagger. I got 40 times my investment, but it was on that initial leg up. Well, we're very close. You know, we came off the bottom of the GDX gold ratio, the HUI gold ratio, the stocks versus gold. I think was 2015 the bottom, Jeff?
Yes, December 2015 was the bottom for gold.
Right. For the GDX gold ratio and the bottom for gold in this this. I refer to all of this. The bottom for gold for me was $253 in 1999, and we've been in a bull market ever since. This cyclical bear market, I call it a mid-cycle correction. I consider 1970 to 1980 a bull market in gold. I don't consider it to be two separate bull markets. I don't look at it that way personally, because what I look at is the value and not the price of gold and silver. And when I see throughout history the value of gold and silver, when you measure its purchasing power against other stuff, it zigzags like this in a range. And that's how I can tell when the bull market is over or not. Trying to split this into two separate bull markets with a bear market in between suggests that it might be easily tradable somehow, that we can catch the top. You know, I could sell in August of 2011 and buy back in, go short on gold until November, December of 2015 and be long now. I'm just not that smart. And most people aren't. And any trader that tells you that he was able to do this exactly is probably lying, or he's going to keep his methods very secretive. He's not going to publish it or tell anybody about it. And I don't think there's anybody out there that has any surefire method of trading a secular bull and splitting it up into these bull and bear markets, nailing every pullback. So we're in the middle of this mid-cycle correction, and we did hit that low in 2015, and we're going through a little bit of a pullback now. And to me, that cycle is something worth gambling on. It's something worth placing a bet on. And when you're investing in stocks, you're placing a bet because your bet is on the management team. Your bet is on the geology of the find. Your bet is that it's in a good jurisdiction that's not going to nationalize the precious metals mines. So an EPA shutdown, a strike, any of these things can basically end that company. And if it ends that company, it goes to zero. The precious metals can't go to zero. But we're in a a low risk, high reward time, in my opinion, for these precious metals. And when I talked about the Barron's Gold Mining Index and the metals outperforming, they tend to outperform when you take one of these broad indexes, about 3-to-1 on the way up, but then about 4-to-1 on the way down. So over a long period of time, the stocks are losing value compared to the metals. But there are these periods of time, if this is the blow-off top that we're going into over the next couple of years here, if this is the blow-off top, and if the echoes of the past continue, then yes, this is. You've got, until November of 2023 would be the perfect echo, history repeating and not rhyming, but really exactly repeating would be November of 2023. It's not going to happen that way, but we're probably getting close to this thing. And if this is it, there's going to be a period of time where the metals the stocks vastly outperform the metals. And then you can sell those stocks and buy more metals on the way up. That's one of the things to do is if you have some profits, take some of those profits, convert it into something that's not going to do as big a pullback. Now, one of the things I discovered on that dividing the Barron's Gold Mining Index into the price of gold was that the peak in that didn't come in January of 1980. It came on the dead cat bounce on gold, which was about a year or a year and a half later, I think it was. Gold went up and then it crashed. And then it did this dead cat bounce to like 600 and something dollars or 700 and something dollars an ounce. It hit 873, did a crash, did a dead cat bounce, and then continued on its 20-year long bear market, 19-year long bear market to, I can't remember what month in 1999, but from 873 down to 253. But the Barron's Gold Mining Index, when you divide it by the price of gold, had a peak and then another big peak, and its peak was on that dead cat bounce. So if you have some exposure to some of the mining companies, you may be able to, I'm trying to use all of these ratios to sell my precious metals in tranches. Around the top, because I don't believe anybody can nail the exact top. And then I'll have my mining companies, which will, they'll go through a giant pullback because, like I said, they're each when you on the downside, they create leverage also, and so they'll go through a giant pullback. But there should be a dead cat bounce in the metals, like there was in the 1980s, and if there is. What happens is the public is rushing toward that sector for safety, and they've seen the leverage that people got on the mining companies, and they chase that. And that's what happened. That's the reason that dead cat bounce goes so high, and the actual peak, it isn't a dead cat bounce on the mining stocks. That's the blow off top, is on the mining stocks when you're in the dead cat bounce on the metals. So I might get to the point where 15, 20, maybe even 25% of my portfolio might be in the stocks, but I will be converting if it exceeds those when I'm in profits, I'm going to turn some of that into metals. If it exceeds these ratios, I'm going to be turning a lot of it into metals until we get to the proper area when it looks like it's time to start converting precious metals into cash flow real estate or high dividend yield stocks or something like that.
Yeah, very good. Mike is right. He and I both just frankly sleep better by making sure we own a very meaningful amount of physical gold and silver first. So I really would encourage anyone who's considering this not to buy mining stocks until you have your financial security set in place. But they can be very exciting. The leverage is very real on the way up, and it's also very real on the way down. My personal portfolio, the allocation is actually greater now in mining equities simply because of this huge run-up they've had here in 2020. So I had more gold and silver value at the beginning of the year, but now I have more in mining stocks simply because of the leverage that we can see from them. During pullbacks, though, they do fall more. So you have to be able and willing to stomach the leverage that comes both ways with the mining stock. So,
yeah, in closing, one of the things that I would like to say is very often people will buy silver or something and say, you recommended that I should buy silver and it went down. Well, that when they say that, it means that they sold and they locked in losses. But first of all, I never recommend anything. I only tell people what I do personally. And so I didn't lock in those losses. Secondly, I've often stated, you've got to have the stomach for the roller coaster. Silver is gold on steroids. When there's a pullback, you're going to have 2, 3, 4 times the pullback in silver than you have in gold. So don't get on silver and don't get on the stocks roller coaster unless you've got the stomach for it.
That's exactly right. Yes, you do have to be willing to handle that emotionally. It can be exciting, but can also slap you across the face. So make sure you're prepared for that. So, well, Mike, this was a great topic. I think the bottom line is there are some exciting times ahead for those of us who are in the gold and silver sector. So thanks very much for addressing this topic, and we'll see you on the next one.
Okay, thanks, Jeff.